Imagine waking up one morning and making $1 billion before sunset, not through years of grinding, not through Silicon Valley innovation, but through one single, perfectly executed financial move that would force an entire government to its knees. September 16, 1992, a day that would become known as Black Wednesday. On that morning, the United Kingdom woke up as a nation committed to keeping its currency stable within Europe's exchange rate mechanism. By nightfall, after spending billions trying to defend the pound, after raising interest rates from 10% to a panic-inducing 15% in mere hours, after watching currency traders circle like sharks, Britain's Chancellor Norman Lamont stood before microphones and admitted defeat. The pound was out. The dream of European monetary unity lay shattered. And one man, a Hungarian-born survivor who had fled Nazi occupation and rebuilt himself in London, walked away with the single largest one-day profit in trading history. His name was George Soros. And the question that still haunts financial markets today is simple. How did he see what an entire government refused to acknowledge? If you're fascinated by the hidden economic events that shaped our world while most people weren't paying attention, hit that subscribe button and the notification bell. This channel uncovers the financial mysteries hiding in plain sight. Now, let's begin. Chapter 1. The Survivor Who Became the Predator. To understand how George Soros broke the Bank of England, you need to understand who George Soros was, and more importantly, what he wasn't. This wasn't some reckless gambler or insider trader with secret information. George Soros was born György Schwartz in Budapest, Hungary, in 1930. At 14 years old, he lived through the Nazi occupation of Hungary, surviving only because his father Tivadar obtained forged identity papers for the family. The experience taught young George a fundamental lesson. The world's stability is an illusion. Systems that appear permanent can collapse overnight. After the war, Soros escaped communist Hungary and arrived in London in 1947, virtually penniless. He worked as a railway porter and a nightclub waiter while putting himself through the London School of Economics. There, he studied under philosopher Karl Popper, whose concept of the open society would shape Soros's worldview. But it was another philosophical concept that would make him billions: reflexivity. Soros believed that in financial markets, people's perceptions shape reality, which in turn shapes perceptions, creating feedback loops that drive markets to extremes. While other traders looked for fundamental value, Soros looked for unstable equilibriums ready to break. In 1969, Soros started his own hedge fund. By 1973, he had renamed it the Quantum Fund, and it was delivering spectacular returns. By 1992, Quantum Fund managed approximately $4 billion in assets and had established Soros as one of the world's premier hedge fund managers. But he wasn't just rich. He had developed a specialty, spotting government economic policies that were fundamentally unsustainable and betting against them. His strategy was called global macro, making massive bets on currencies, bonds, and commodities based on macroeconomic trends. He didn't analyze individual companies. He analyzed entire economies, looking for the fault lines where political promises collided with economic reality. By 1992, Soros and his chief strategist Stanley Druckenmiller had turned their attention to Europe. The European Exchange Rate Mechanism, or ERM, had been established in 1979 as a stepping stone toward a single European currency. Member countries agreed to keep their currencies within a fixed range against each other, primarily pegged to the strong German Deutschmark. The theory was elegant. If weaker currencies like the Italian lira or British pound stayed linked to the mighty German mark, those countries would import Germany's low inflation and monetary discipline. It was monetary unity by peer pressure. And for a while, it worked, but there was a fatal flaw in the design. What happens when Germany's economic needs clash with Britain's? What happens when political promises override economic reality? In 1990, When Britain joined the ERM at a rate of 2.95 Deutschmarks to £1, Soros sensed something was off. The pound looked overvalued. The British economy was heading into recession, and the ERM would trap Britain in a cage of its own making. The setup was complete. Now came the build. Chapter 2. The trap Britain built for itself. When Britain joined the European exchange rate mechanism on October 8, 1990, it was supposed to be a triumph. Prime Minister Margaret Thatcher, though personally skeptical, was persuaded by her Chancellor John Major that joining would help control Britain's stubborn inflation problem. The pound entered at 2.95 Deutschmarks, with a permitted fluctuation band of 6% in either direction, meaning it could trade between roughly 2.77 and 3.13 marks. If the pound approached those boundaries, the Bank of England was obligated to intervene by raising interest rates or buying pounds with foreign currency reserves. But from the moment Britain joined, the economic fundamentals were working against this arrangement. The British economy was sliding into recession. Unemployment was climbing toward 10%. Meanwhile, Germany was booming. After reunification in 1990, West Germany was pouring money into rebuilding the East, creating inflationary pressure. To combat this inflation, Germany's central bank, the Bundesbank, kept interest rates high, very high. Here's where the trap closed. Because the pound was pegged to the mark, Britain had to match Germany's high interest rates or risk the pound falling and breaking out of the ERM band. Think about how insane this was. Britain's economy was in recession, with rising unemployment conditions that screamed for lower interest rates to stimulate growth and hiring. But instead, Britain had to maintain interest rates around 10% to defend the pound's value against the mark. It was economic medicine designed for Germany's overheating economy being forced down Britain's throat during a recession. By mid-1992, George Soros and Stanley Druckenmiller were studying this situation with predatory focus. Druckenmiller had initially wanted to short £200 million worth of pounds, a significant but measured bet. Soros looked at his protégé and said something that would become legendary in trading circles. Go for the jugular. This is a once-in-a-lifetime opportunity. They began building their position, eventually shorting approximately $10 billion worth of British pounds. Let me explain what that means. They borrowed pounds from various banks, immediately sold those pounds for other currencies like Deutschmarks and dollars, and waited for the inevitable. If the pound's value fell, they could buy back the pounds at the lower price, return the borrowed currency to the banks, and pocket the difference. It was a colossal bet that Britain's government could not and would not be able to defend the pound's ERM level. But Soros wasn't alone. Other currency traders from major banks to rival hedge funds saw the same fundamentals. The pound was overvalued. Britain's economy couldn't sustain high interest rates. And the Bank of England's foreign currency reserves, while substantial, were finite. As summer turned to fall in 1992, the pressure built. The pound began sliding toward the bottom of its permitted RAM band. The breaking point was approaching. Chapter 3. The day Britain surrendered. The weekend before Black Wednesday was tense. Currency markets were closed, but behind closed doors, British government officials knew they were in trouble. The pound was weakening, and speculators were circling. On Monday, September 14th, and Tuesday, September 15th, the Bank of England spent billions from its foreign currency reserves buying pounds to support the price. It was like using a bucket to bail water from a sinking ship while George Soros and hundreds of other traders were drilling new holes in the hull. Wednesday morning, September 16, 1992, arrived with a sense of inevitability. Trading opened in Asian markets first, where the pound immediately came under heavy selling pressure. By the time London markets opened, it was clear this wasn't ordinary volatility. This was a coordinated assault. Traders weren't just selling pounds, they were dumping them in enormous volume. George Soros's quantum fund was selling. So were traders at Citibank, at Deutsche Bank, at dozens of other institutions. The message was clear. We don't believe Britain can hold this line. At 10:30 a.m., the British government made its first desperate move. Chancellor Norman Lamont announced that interest rates were rising from 10% to 12%, effective immediately. The logic: higher interest rates make a currency more attractive to hold because you earn more interest on deposits. If rates go up, investors should want pounds. But nothing happened. The selling continued. The pound kept falling. Soros kept selling. At 2 p.m., the government played its final card. Lamont announced that interest rates would rise again to 15%. 15%. To put that in perspective, mortgages, business loans, credit cards, everything would be tied to this rate. Businesses would go bankrupt. Homeowners would lose their houses. Jobs would vanish. The human cost of defending the pound had become catastrophic. And still, the traders didn't believe it. They knew what the government hadn't admitted yet. This was unsustainable. You cannot maintain 15% interest rates in a recession. The damage to the economy would be worse than just letting the pound fall. Behind the scenes, the Bank of England was hemorrhaging foreign currency reserves, spending an estimated £3.3 billion. Some reports suggest the real number was much higher, trying to buy pounds and prop up the price. It was like standing in front of an avalanche with your hands up, trying to hold back billions of tons of snow with sheer will. By late afternoon, Prime Minister John Major held an emergency meeting. The military metaphors were apt. They were out of ammunition, reinforcements weren't coming, and retreat was the only option. At 7 p.m., Norman Lamont stepped before the cameras at the Treasury and delivered the announcement that would define his career. Britain was suspending its membership in the European exchange rate mechanism. The pound was free to float. Interest rates would return to 10% the next day. The 15% rate had lasted just hours. Britain had surrendered. George Soros had won. Chapter 4: Winners, Losers, and $1 billion. Within hours of Lamont's announcement, the pound plummeted. By the next morning, it had fallen approximately 15% against the Deutsche Mark and roughly 25% against the dollar over the following weeks. For George Soros and the Quantum Fund, this meant unfathomable profits. They had shorted approximately $10 billion worth of pounds. When the pound fell 15%, that translated into roughly $1.50 to $2 billion in profit, with Soros personally earning an estimated $1 billion. To put that in perspective, he had made more money in a single day than most Fortune 500 companies earn in a year. Other traders made fortunes too. This wasn't just Soros's victory, but he became the face of it because of the sheer scale of his bet and his willingness to go for the jugular. For Britain, the immediate aftermath felt like a national humiliation. The Treasury had spent billions defending the pound and lost. The government's economic credibility was shattered. John Major's Conservative government, which had won re-election just months earlier, would never recover politically. The phrase Black Wednesday entered the national vocabulary alongside other days of infamy. Norman Lamont, the chancellor who had overseen the disaster, became a figure of ridicule. In Parliament, opposition leader John Smith delivered devastating attacks, mocking the government's incompetence. One famous exchange had Smith asking Major about economic policy, to which Major could offer no coherent defense. The Conservatives' poll numbers collapsed, and they would remain in the political wilderness until their crushing defeat in the 1997 election to Tony Blair's Labour Party. But there was a twist. While Black Wednesday was a political catastrophe, it turned out to be an economic blessing in disguise. With the pound no longer shackled to the Deutsche Mark, the Bank of England could finally set interest rates appropriate for Britain's actual economic conditions. Rates came down. British exports became more competitive with a cheaper pound. The housing market stabilized. Businesses could borrow affordably again. Within months, the British economy began recovering from recession. Unemployment peaked at 10.6% in December 1992 and then began falling. GDP growth turned positive in early 1993. Inflation remained under control despite the devalued currency. Economists later concluded that leaving the EUR was probably the best thing that could have happened to Britain's economy, even though it felt catastrophic at the time. The human cost, however, was real. Thousands of businesses that had struggled during the high interest rate period had already closed. Families had lost homes. Jobs had vanished. The recession's damage had been done, and Black Wednesday couldn't undo that suffering. For George Soros, the moral implications were complex. He hadn't caused Britain's problems. The overvalued pound and misguided ERM membership had done that. He had simply recognized reality before the government did and profited from inevitable market forces. But he would forever be known as the man who broke the Bank of England. Chapter 5. How One Day Changed Decades. The long-term consequences of Black Wednesday rippled through British politics and economics for decades. Most immediately, it fundamentally altered Britain's relationship with European integration. Before 1992, there was genuine political momentum toward Britain adopting the euro, the single European currency that would eventually launch in 1999. After Black Wednesday, that momentum evaporated. The British public had seen what happened when their economy was hitched to Europe's monetary policy, and they didn't like it. When the euro was established, Britain negotiated an opt-out, keeping the pound sterling as its currency. A decision that, in hindsight, gave Britain crucial monetary policy flexibility during the 2008 financial crisis and subsequent Eurozone debt crisis. Some historians argue that Black Wednesday planted the seeds for Brexit decades later by associating European economic integration with British economic pain. For George Soros, the victory made him simultaneously famous and infamous. In financial circles, he was revered as the trader who had made the perfect call, executed flawlessly. Business schools taught case studies about his trade. Aspiring hedge fund managers studied his philosophy of reflexivity and his willingness to make concentrated bets when conviction was high. But he also became a controversial figure. Some accused him of harming ordinary British citizens for his own profit, though economists generally agreed he had simply recognized an unsustainable situation. Other governments that had been running questionable economic policies looked at the Soros trade and felt a chill. If Britain, with all its economic might and the Bank of England's reserves, could be defeated by currency speculators, then no government was truly safe from market forces. This realization would play out again when Soros and other hedge funds targeted Asian currencies during the 1997 Asian financial crisis, leading some governments to implement capital controls to prevent similar attacks. The Bank of England itself underwent significant changes. The institution had been humiliated, having spent billions in a failed defense. But the experience taught valuable lessons about the limits of intervention and the importance of aligning policy with economic fundamentals rather than political commitments. In 1997, newly elected Prime Minister Tony Blair granted the Bank of England operational independence in setting interest rates, removing that power from politicians who might be tempted to prioritize elections over sound economics. This independence is now credited with helping Britain maintain low inflation and economic stability for most of the subsequent decades. Stanley Druckenmiller, Soros's chief strategist, who had helped orchestrate the trade, went on to have a legendary career of his own, eventually managing Duquesne Capital to spectacular returns. The Quantum Fund continued operating successfully for years, though never quite replicating the singular triumph of Black Wednesday. By the 2000s, Soros had largely stepped back from day-to-day trading to focus on philanthropy and political activism, though his investing acumen and his one greatest trade continued to define his public image. The $1 billion he made in a single day became the stuff of financial legend, a reminder that markets, not governments, ultimately determine currency values, and that sometimes the most profitable trade is simply recognizing reality before everyone else does. Chapter 6. What Black Wednesday teaches us today. So what can we, sitting here decades later, learn from the story of George Soros and Black Wednesday? First, unsustainable systems eventually break, no matter how committed governments or institutions are to maintaining them. Britain wasn't defeated because George Soros was particularly clever or lucky. Britain was defeated because it was trying to maintain an economic policy high interest rates during a recession to defend a currency peg that was fundamentally incompatible with its economic reality. Second, there's a powerful difference between being right and being right at the right time. Many traders had recognized months or even years earlier that the pound was overvalued in the ERM. But Soros and Druckenmiller didn't act until the pressure had built to a breaking point, until the Bank of England's reserves were running low, until the government's political will was cracking. Third, when you have genuine conviction based on thorough analysis, size matters. Stanley Druckenmiller wanted to bet $200 million against the pound, a large position, certainly, but measured. Soros said, "Go for the jugular." They eventually shorted $10 billion. This wasn't recklessness. It was calculated aggression when probability and magnitude aligned. Fourth, political pride and institutional inertia can blind even smart people to obvious realities. The British government had smart economists. The Bank of England had experienced officials. Yet they spent billions defending an indefensible position because admitting failure was too painful, because they had publicly committed to the ERM, because walking back that commitment felt like weakness. This cognitive trap affects us all. Finally, remember that in markets and in life, other people's perceptions become reality through reflexive feedback loops, Soros's key insight. If enough people believe something will fail, their actions make it fail. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel.